9 o'clock, I'm going to go ahead and call the meeting to order. I know we have a couple of members. Is Matt going to join us remotely?
Matt will not be attending. He's on a flight at the
That's
moment.
right, that's right. Okay, all right, very good. And Pat might be here depending on his...
I think he's on.
Oh, Pat, that's great. Oh, fantastic. All right, fantastic, Pat. Sorry, I didn't see you. You're too small on the screen for me to read you. All right. Well, I'm going to go ahead and call this meeting to order.
Oh, okay.
Let's start with
Thanks very much.
with attendance. John Vischer, member.
David Rader, member.
Fred Martin, Discipline Growth Investors.
Nicholas Hansen, Discipline Growth Investors.
Harvey Loss, member.
Greg Williams, staff. William Johnston, staff.
Brendan Vavrika, Anco Consulting.
Mark Benton, staff.
All right, very good. Everyone's accounted for. Fantastic. Well, we have an agenda in front of us. I'd be happy to entertain a motion to adopt.
So moved.
Do I have a second? We have a first and a second. All in favor, play aye. Aye. Agenda is adopted. All right, we have the minutes from our last meeting, December 15th. Are there any additions, deletions, changes, complaints that you would like to raise at this time? If not,
Move the approval.
I got approval, and I got a second. All right, our minutes from the last meeting have been approved. All right. Next on the agenda is our longtime manager and friends from Discipline Growth Investors. Fred, Nick, you guys have the floor, and here we go.
So Nick and I are going to, only one handoff and then back to me, I'll carry it off. Just some comments. First of all, I want to thank you again. I think this is year 41, I think, since I came down here. And for years, money was allocated away, and then it got too much, and I would complain about it. And my issue was that we weren't big enough to move anything, and so you guys have corrected that. Thank you. We actually take this. We actually think about the pass-through. You know, the fiduciary obligation is to not only report to the committee, but think about the participants in the plan. We actually think about that stuff, and so you have us in the right spot. Thank you very much. And so we're very energized. Let me kick something off because in the 40-some years, I've never come down right in the morning of an announcement of the Russian invasion of Ukraine. So let's talk about that for a second. You know, our focus is, first of all, our process is always analyze, analyze, analyze. We did that when COVID hit. We probably spent 2 months analyzing, thinking about it before we started moving around. So we'll analyze, watch, analyze. You know, you have a headline thing and we're watching on TV and it's really, you know, like, whoa, what does it mean? We don't know yet. We'll speculate. I'll ask Nick in a second. We'll speculate on some things that could happen. Our focus will be on, as always, does this affect the 7-year outlook for our companies? That's what, okay, that's where we're going to focus. And so we'll see what happens. One thing that's, there's a saying, it's better to be lucky than good. So we go into this with 8 or 9% of the portfolio in energy-related fossil fuels. You talk about a controversial place to be. So how do we end up there? So just think about us as investing in innovation at all levels. Products, internal controls, distribution systems, okay? So back in 11, I think 2011 or 12, we noticed that there was a hockey stick thing going on. It wasn't global warming hockey stick, it was oil production U.S. hockey stick. It had gone down from 69 on, steadily down. And it did a hockey stick starting around, I think it was 8 or 9, and it was going like this. What the heck's going on here? So, and we knew there were 2 technologies. Well, there was one that we knew about, which is called 3D seismic. Horizontal drilling developed, and you think about pools of energy, you think they're horizontal or vertical. They're horizontal, so you get horizontal drilling, and they can do right angles that go out miles. Then the third one was this thing called hydraulic fracturing, okay? There's a great book if you want to get an idea. One of the things that happens on innovation is it's often somebody in their garage. You know, the Apple computer was invented in the garage, right? And if you want to get a fascinating book on innovation, read about the Wright brothers, a book by McCullough.
Oh, that's a great book.
Isn't that a great book? Well, that's innovation. Two nobodies, two bike mechanics from Dayton go down to Kitty Hawk, and they had the big buck guy, I think his name was Langley or something, that had all this money, and he flopped, okay? So, the quote, hydraulic fracturing started because a desperate CEO, George Mitchell of Mitchell Energy, had a gas contract with the city of Chicago, and he was running out of gas. He had a problem. And he knew there was all kinds of gas in the shale formations. So he set about to do that. It took him about 20 years, and they unlocked it. So we're watching oil production rise and gas production rise. And so we get really interested in massive innovation. So we're watching this. And these are repeating phenomena. You get innovation, everybody gets all excited about the potential. They price the stocks to the moon. Too much capital flows in the area, it destroys the returns, the stocks get destroyed. We lost one company in there, fought the battle and lost it. Coming out the backside is where you make serious money. Just to give you an idea of what I'm talking about. You know, personal computer stocks and to some extent the web exploded in the late 90s. They all got destroyed, and you may remember that in the 02 to 05 timeframe, the consensus was you could not make money on the web. Just think about that. You could not make money on the web. So Facebook couldn't be a success. None of them could, okay? Well, that turned out to be wrong, okay? So we're sitting there watching this stuff. We think the U.S. is one of the major producers in the world. Now we're the largest, okay? So we ended up with one service company and two domestic natural gas producers. And their low-cost production, it's a growth business, by the way, because of LNG. We've run all the math, okay? It's also, when you think about investing, if you own a commodity, you don't want to say, the commodity has to go way up in price for us to make money. You want to say, if the commodity trades at a fair price for the next decade, we'll make a fortune. And that's kind of where they're at. Because they keep reducing costs. So we own two, they're now national producers, Southwestern Energy and Coterra. The industry's becoming very shareholder friendly, okay? And, you know, now, I tell you, don't take this as a political comment, take it as an economic comment. When President Biden was elected and he canceled the Keystone Pipeline and, you know, restricted drilling, I thought, hallelujah, baby, our stuff just got more valuable because they were already on the assets, okay? Well, now, you know, how valuable is LNG? Now, we also have studied carefully, and we're looking at all kinds of competing technologies because you don't want to be blindsided by that, okay? We think the electric vehicle thing is going to continue to grow, probably, but it runs on electricity. There's a huge problem with renewables. It's a huge problem, and it's intermittent. And electricity needs a continual source of power. Duh, okay? Let me give you one more number. You know, gas prices in the U.S. are 4 something per MCF, BCF, whatever, BCF, MCF, whatever, $4. In Europe, they're 11. It costs $2 to ship it to the coast, liquefy it, cool it, liquefy it, ship it over, and, you know, let it warm up. And so we can sell gas in Europe for 6, and the prevailing price is 11. Now, it strikes me as a pretty good deal, okay? All this does, this Ukraine thing initially helps domestic energy producers. Now, I don't know what the Biden administration is going to do. I know what I'd do if I was in his shoes. I'd pass tax credits to get more LNG ships and terminals going because we are going to be one of the big sellers of LNG around the world. So it's just a kind of a story that we ended up in a spot, not because we're trying to predict commodity prices, but we saw massive innovation. And it's a gift. It's an absolute gift. Gas is cleaner than coal. Gas is taking share. Gas is going to be the dominant, you know. So we'll see what happens. One of the obvious things that has happened repeatedly in my lifetime is recessions come often when energy prices go up. It has a double effect. One is you have to fill your car. You got to go to work. So your wallet's getting squeezed, and energy is ubiquitous. And then the other part is, because you have to fill your car every week or two, it works on your psyche. I don't care who you are, you go ahead, oh man, this was, what did you say, you're paying $1 more, Jim's paying $1 more.
I paid $4 a gallon recently.
Yeah, I mean, right, you run a mental calculation on this sucks. And so it works, so that can create a recession, maybe. It's early, but it could create a recession. Do you have anything to add, Nick?
I mean, no, I think we can go down a whole bunch of different rabbit holes with speculation on what this means, but for energy commodity prices, asset prices in general, is there going to be a run on the store with supply chains now, stress them even more? Are people or companies going to get freaked out by this? There's a bunch of pieces. I think, the theme throughout this presentation is we go back to our companies and say, will they thrive in a 7-year horizon, not next year in the face of a Russian invasion? And I don't think this changes much. We didn't predict the Ukrainian invasion. I think I have a bullet point somewhere in here on geopolitical tensions, which is pretty vague. But I do think that none of the arguments we're going to make about our portfolio will change in the face of it.
Nick and I already talked about this morning. One of the issues is, does China become more adventuresome toward Taiwan? That's the big one. Okay, we have a company that is a spectacular company, but big supply out of Taiwan. Tough. So
we do have supply chain exposure to China with a number of our holdings.
Yeah. So we're going to have to work our way through this stuff. You should reasonably expect we'll do it slowly and carefully. We'll think about it. We'll talk about it at length. I noticed this morning that the index that was down the most was the NASDAQ, and the NASDAQ is the most expensive index, that's where most of the money is. So if they're not selling, we'll see what we do today, but they're not selling. They sell what they own. If the public's going to back off, they're going to sell index funds. So I'm going to be surprised to see index funds get pretty early, particularly the S&P 500. So I just thought it's topical. We talk about it a little bit. We'll do this, what you reasonably expect. We'll talk about it. We'll think about it. We spent a long time on COVID thinking about what it meant. Trying to figure out what's sustainable, what's not. Okay.
And with COVID too, I think that was illustrative because we initially made a couple of quick moves within the portfolio that were just, they're based on what was happening, which was pretty rapid. But by and large, most of the activity you saw was months after COVID hit. And that was just because there wasn't a rush and we deliberated and did our research. So I would expect the same thing here.
One of the things you run into right now is you say to yourself, okay, so this is not good news, the Ukraine thing. But COVID is opening up gradually across the country. And of course, we're a little jealous coming out of Florida. We're still wearing masks in the Skyway system in Minneapolis. And we're also, until about a week ago, you had to order to go to a restaurant downtown Minneapolis, you had to have your vaccine card. And as Nick said, we'd go in to talk to the restaurant owner. They had no enforcement mechanism. You could have signed a card and said, I'm vaccinated, and showed it to them. I mean, so it's uneven, but it's slowly opening up. And Omicron, we looked at Omicron really carefully, and Omicron is the best news we've seen on COVID. But we think there may be some real changes. COVID's 2 years old now. We've been living with this for 2 years. World War II started with Pearl Harbor at the end of 41. And D-Day was the middle of 44, that's 2.5 years, so that's pretty, we're pretty deep into this, so we'll see what happens. If COVID's, if we lift the restrictions, that has to be positive economically, but we'll see what Ukraine does. So we'll keep you posted, but what I would like to reassure you on, we'll do it slowly and carefully, we'll think about it a lot. You don't want to overreact to this stuff, okay, because that's often the worst thing you can do. So I'm gonna cover the first part of this. If you turn, I'm going to skip past the stuff we always put in there about optimizing the client base. And we do have a goal of being a 100-year firm. Let's go to page 6 because we've had some really internal and external challenges the last couple of years, and I think we like to be transparent as possible. The only thing we won't discuss is individual client stuff, and decisions that are pending, but past decisions we're open to discussing, and so the goal is to be transparent. So we'll delve into this a little bit more, but we had a challenge all last year on valuation in the market. It started off in January, and we had two stocks that there's this red hot money manager called Art, Kathy Wood, and she made a terrible mistake of mentioning one of her stocks that we owned, and the stock went nuts, so we sold a bunch of it at 250, and it's now 50, and we had another stock that caught in a short squeeze, we sold into that, and so we struggled all year to maintain our 12% hurdle rate. We'll talk about that a little bit more. COVID, you're all familiar with the challenges there. When it hit, Rob is immunocompromised. He's the other than me, the other senior guy, and we just decided we were coming to work every day. We're a small firm, we're not taking public transportation. We had a mission, which is to serve our clients, and so our young guys, our young analysts said, "Are you sure that's wise?" We said, "I don't know, we're going to do it." And so about 4 months later, they came in and said, "This was the greatest learning experience we've ever had," because we were there. We really upgraded our video conferencing. A curious thing, CEOs were home. CEOs love to talk. We had about 80 CEO calls during the summer of 2020, and I mean, it was fabulous. We were getting just great insights, etc. So I don't want to minimize the epicenter of the social disorder was Minneapolis. So for about 9 months, we drive to work, we drive by a barbed wire fence around the courthouse with armed National Guardsmen. That really does wonders for your psyche. You think, boy, isn't it a wonderful world? So we had a lawsuit from a large shareholder, member of the investment team, 20-year veteran. Had performance issues, went on leave, came back, sued us. I'll talk a little bit more about that. And then we lost a large shareholder, Robert Buss, who the best way I can characterize him, you know what I'm saying here, he was the Brian Sargent of DGI. Just an absolutely thoroughly fine human being, incredibly talented. Personally, I lost a son 6 weeks before Robert died, so it was an interesting year. So let me close the lawsuit. We were sued in May of 2020, right in the middle of COVID, and thank you, Minnesota. They were clever enough to find a law that allowed them to pierce the corporate veil and sue 4 of us individually. We started slowly in the suit because we were very worried about him, compassionate, and once we figured out what was going on, we took charge. By July, we were running, we were making things happen, let me put it that way. Our suit was getting stronger. His suit was without merit, but you have to settle these things. So our CEO and I sat down with our attorneys. We had an attorney in right from the start. And in July of 2020, we said, we got to settle this. So this is, and there was a further action under our shareholder agreement, you're restricted to arbitration. So there was an arbitration claim filed in September. So fast forward to January, we had a mediation session, 13 hours, and we got it done. And it was more than we wanted to pay, but it was affordable, less than he wanted. Took 12 hours, and then they finally got reasonable, and we hit the bid, and we're done. That's record time. We got it done, and full release of all. He went on leave in October of 2019, and I went in to see Rob. Rob and I had been the senior guys, and I said, "How you feeling?" He goes, "Relieved." I said, "Me too. Let's get this baby going." So we started working, and we'll talk a little bit more about where our investment team at, but we are functioning at an incredibly high level now. So that's done. 6 weeks after my son died, I got a call from Robert on my phone. It was his. I picked it up. "Hey, Robert." It's his wife. She's sobbing. She said Robert was just hit and killed by a train. He was walking his bike across a railroad trestle bridge with his earbuds in. So we all agreed that's not the smartest thing. And a freight train came along, this freak thing, killed him. That night, all of the senior people were at his house supporting his wife. We had a meeting, we called every employee that night to tell them what happened. We had a meeting the next day, and so everybody's still, it's a great guy. We are interviewing to replace him. Not in total, but we're deep in the process. And our process, it takes forever. The interview, we're down to 5, and they've met every single person in the firm, been interviewed by him, because that's the kind of place we are. And so, and we have very good candidates, so it'll be interesting to see what we decide. We spent a lot of the last 2 years, rotating capital, if you will, into higher expected returns. We're right at 12, but we'd like to be above that if we can. 12% hurdle rate, 12% expected return. We have been working very hard on continuous process improvement, and one of the things we decided is we could do better portfolio weightings, allocate capital better. Our core research thing is really powerful, but we had a fairly crude allocation process, so we're fine-tuning that, and we're going to continue to work with that. We are working on relocation. We may move to the burbs and maybe buy some land or something and have some space and, more of a, less of a downtown kind of a focus. We don't know that. We'll run real slowly and carefully. And boy, we've had tremendous evolution of our investment team. On top of Scott leaving, we had 2 youngsters that came in, and wonderful young people. So we're integrating them, and they're really starting to take hold. We promoted Nick. He was in process to be promoted before Scott left, and we promoted Jason, so now there's 4 senior members of the investment team, and we are really functioning at a really high level. It's the best research, the best set of bets in my career. It's just really fun.
Fred, quick question. Could you talk about the weighting?
Yeah.
But just briefly, could you kind of explain your kind of revision of how you're weighting? You got great ideas, but now you're trying to decide.
Well, so we used to have a 1, 2, 3 kind of thing, 1%, 2%, 3%, as our conviction grew. So we might go to 1.5, we might go to 1.75, but we're also trying to bring in the idea of using insights. And we've been doing a lot more because of technology. When we interview managements, we'll put the whole team in there interviewing the CEO, and then we'll talk about different viewpoints of what it looks like. And so we're trying to be, if you think conceptually, what you'd like is, we've always had about 10 stocks be 35% of the portfolio, the top 10 holdings. They've earned their way there. We think we could have bigger positions of the next 20, and then we'd have 10 or 20 50 basis point positions, which is our farm team, and we would be more harsh about in or out, up or out, okay? So it's just, it sounds doesn't sound that big, but when we remember, we go back, when we do our offsites, we do it 1 every year, we can go back and look at all of our decision history, everything we've done, and we decided that if we can improve that weighting, we could add as much as 2% a year to the portfolio returns. And that's the highest we've ever seen. Now, this is not magic stuff. This is a lot of work thinking about it. It's something that has been on my mind for years, and the young people came up with it, and I'm just ecstatic about it. So, I went back and thought about this. So for first 18 years with Gainesville, I did this myself. I didn't have a research team, so my weightings were really good. That's probably why the numbers were so good. So, as you build a firm, you do it in stages, right? And if you are a believer in continuous process improvement, you start with a really strong approach, but you keep trying to make it better. So what you should think about is it should be a slow improvement, and a little bigger, we're more willing to go to a 4% when we have things lined up, okay?
Internally too, the one thing I'd add is what Fred said, if you start out, you're doing it yourself, you're not putting the weighting decisions through a committee. You've got all the stocks in your head, and you have the weightings that you associate with them, you're comparing all of them. Now, I mean, with more bandwidth to do research, we're doing far deeper, more detailed research on a lot of our holdings, but it's by different members of the team and integrating that information, because everyone has a different communication style, everyone's got a different level of experience, so making sure that we incorporate those and still make the best weighting decision. I mean, that's the part, I think, from a team standpoint, we're really learning our way into.
And I'm fascinated with this because I think we can materially add to our numbers. A couple other things, just updates on the firm. We've always maintained, a lot of people said, well, why don't you have more products, right? Because that would reduce your risk. Well, the problem is, can you really do God bless them, good luck, but the idea of having like 5 different investment teams, okay, whatever. It's not my cup of tea. We do 2 things. Actually, we do one thing really well. We do 2 things. We buy little companies that grow into big ones. We buy mid-sized companies that grow into big ones. And we have a lot of residual experience. You can de-risk the business by maintaining extreme financial strength at the shareholder level and at the corporate level. So we have an extremely strong. That's how you de-risk it. Okay, because if our stuff's out of favor, we run client risk. But we also start every year not knowing what the market's going to do. So you have to be prepared to withstand that. So we have extreme financial strength. We're actually bullish on technology CapEx the next several years, and we're part of that. So we're 20 people. We're spending $1 million this year on Salesforce, a big CRM, and we have that other thing we're doing for the investment team.
Yeah, it's an extension of Salesforce, the research management system. So
Yes.
I've talked to you in years past about SharePoint, which is basically making sure that we have a unified, well-organized repository of all our past decisions, our past research, et cetera, so we can get kind of a feedback cycle going over these 7-year forecast horizons, which is tough enough. Salesforce is really going to take that to the next level, because not only is it just a far better system for integrating and analyzing data, it's going to integrate then with the client systems as well. And so we don't just have a generic portfolio we're analyzing here, and then a bunch of client-specific stuff with a wall between them. We can really start to connect the dots on how all these things interact and what they mean.
So that's
Okay, great.
that's what we're doing, okay? On performance, you guys get all this stuff dialed in. This was performance last year. We were up 14. It looks like gross of fees. Trailed the Russell mid-cap value stocks. We did better. The S&P was a superstar last year. It went up big in the fourth quarter, and we went up a little bit. We exceed our hurdle rate. We're always trading somewhere between the Russell mid-cap growth and the Russell mid-cap. And over time, we beat both of them. And if you look at it, this is since we started 15 years, 40 years and 9 months, 15.1%. By the way, that predates the Russell Mid-Cap Growth Index, so I've done this longer than the index has been here, and that's about 200 and some basis points above the mid-cap and about 300 and some over the S&P. Not that when you guys hired me then at Mitchell Hutchins back in '81, I had no idea we cranked numbers like this. This is almost unheard of performance-wise. It's about the best record you can find anywhere. I can talk about, sort of the evolution of it, but, it is what it is, okay? Obviously, I'm very proud of that. Here's how we're doing so far this year through February 15th. We're down 7.8. Again, the growth index is down. We're growthy. It's down almost 12. And mid-cap's down 6-something. The SP's down 6-something. So I don't see us tracking unusually anywhere. We have a really, really wonderful expected return going forward. Here's the history, 331.81, you get 2.9 million, 53 is coming out because a lot went out, then you put a lot back in. So we've made the pension fund 136 million, and as of 12/31, it's worth $86 million. I hope you can appreciate the sense of satisfaction that somebody like me gets. You hired me years ago, we transitioned to a firm that I am forever grateful that the city transferred the contract to us when we started DGI without a bid review, which was, oh man, you know. Whew. But it worked, and I think we've paid you back, but this has been a wonderful, you know, we helped the city, we helped employees of the city, you know, that's what this is all, you know. Years ago, I was talking to a friend of mine, one of my close friends who also passed away last year, and you know, he was a physician, and he was so gifted at uncrossing kids' eyes, and he uncrossed 17,500 eyes over his lifetime. Kids walk in cross-eyed, walk out straight. And he was a Jewish guy. I said, you schmuck. I said, you know, you'll have 17,500 on your tombstone. Mine will say, he made rich people richer. Boy, that just gets me so juiced up, right? But truthfully, we've changed a lot of lives. We've helped, you know, and so we take this is an obligation, guys. And so we take it. We own what you own, by the way, just so you're aware, because we eat our own cooking. And I don't mean like we own a little bit of what you own, like try 100%, okay? So anyway, I'm gonna, let me just stop there. Any questions about where we are? Nick's gonna talk about some of the stuff we're seeing, but any questions about where we are? I want to thank you again. This is an amazing story, by the way. I've always said that. This is one of the untold stories in the state of Florida. It's an amazing story, how you could have a manager being offered. So now our goal is 60 and then 80. How about that? Wouldn't that be cool? I mean, just, you know, so we have to earn it, so.
There's very few people who have put up with you for 41 years.
I've angered a few people on occasion. That one consultant member, I was upset about something that he didn't last very long. He told you guys I should ever speak to you. That was probably not a great
So
idea.
Nick, I'm guessing about 20 minutes, what we have left, so kind of, I don't want to truncate. We
No,
gotta go longer,
I'll
I'm
be
trying to
quick,
give a
because
sense here.
most
Yeah.
people have heard most of this, so
Okay, so,
I can flip through it, mainly just.
Sorry, John.
no, you good, no, this is good perspective.
I'll just highlight a couple things, and then try and get to Q&A, and you guys can draw what you'd like to
Okay,
from that.
perfect.
So there's only a few slides here, really quickly. We have this first one on slide 12. All it's meant to do is kind of illustrate one dimension of all the weird valuation distortions that were happening over the last year, and there's a lot of causes to that. COVID obviously distorted the business operating environment for a lot of these companies, and the valuation that resulted from that. I mean, the managers didn't know what their companies were worth, and we have even less insight than they do, and so the valuations went all over the place. This was probably largely driven, like Fred said, by a short squeeze. Kathy Woods, you had a lot of retail traders pushing into a select group of stocks, and when we saw it go up like that, again, this isn't because we're prescient traders and market timing really well. We just honored the valuation discipline and happened to look really good because we top ticked them. But you can see that we were also with, you know, you can, if you squint, you can see that after the drops, it tends to be where we rebuilt or built positions in these companies. But I think this stock, or this chart, really kind of illustrates a lot of what we were doing in the portfolio, but in a little microcosm. The next page just kind of zooms out to the market valuation. So these are the forward PE multiples for the next 12 months for the S&P 500, which is large, S&P 400, which is mid, and S&P 600, which is small. And then the orange line is the mega caps. I'll touch on those in a sec. The one caveat about the S&P, they require profitability to go into the index. So while it's a huge chunk of market capitalization, this doesn't even capture a lot of the profitless SaaS high flyers that you'll see more in the Russell Mid Growth. But we like this because I think it represents kind of the fundamental environment of these long-term business models in the U.S. economy. The one, obviously, we put it in orange, is the mega cap 8. That's just the concentration at the top of the S&P, Apple, Microsoft, Amazon, Google, Facebook, Tesla, NVIDIA, and Netflix, which is a remarkable degree of sector concentration. It's probably 30% or better of the index, and it shows the forward PE attached to those. These are by and large, I mean, maybe Tesla and a little bit with Netflix accepted, incredible business models and tend to be very, very profitable on a durable basis. But the PEs have continued to rise and rise, and you see what they've done with growth and with profitability at the scale they have. It's nearly unprecedented, but at a certain point you pay too much for anything, and we've done some various slicings on individual companies like Tesla, but also on them as a whole, and saying, okay, how do we get to a return, given the cash that they're likely to generate over the long term? And it's very hard to get above a low single-digit % return in the longer run. And it's not because these companies are not fundamentally incredible. I mean, there's stuff still to resolve with a couple of the business models, but they're amazing companies. It's just you front-end loaded so much of the returns at this point, and you see that in the orange line there. Zooming back into the portfolio, despite that, we're not trying to make money on valuations, which, especially with what the market's been doing the last 3 to 6 months, really puts us in a great spot because we invest to make our money longer term on fundamental progress. With each of these, we're not trying to, we have a valuation discipline that protects us on the downside, and hopefully over the long term gives us a little bit of a tailwind to our returns. That's what we've historically found. We get about 10 points of performance just from the fundamental progress our companies make every single year, and the fact that we own them for a very long time. We do get a few points of benefit from valuation, but that is not where we're trying to make the money. And to illustrate that, these are the top 15 holdings. So this is really the stable core of the portfolio. Brett talked about the farm team, smaller positions that they're newer, we're less certain on. You'll probably see more turnover at that low end position size-wise of the portfolio. These ones, we put 3 columns on. A line in the top position, it's sorted by size. You have revenue growth, and this is going to be from the first 3 quarters of 2019, so pre-COVID, to the first 3 quarters of 2021. We'll update that to full year, but we haven't had a full earnings reporting season yet. So this is really to compare how they've done in the face of COVID. So what progress have they made point to point? So a line grew revenues 66%. That's in some senses really incredible because it's a large discretionary purchase for most people, and you actually have to in person go into an orthodontist's office. So to drive that sort of performance and something that people have a choice on in the middle of a pandemic is spectacular. I mean, it speaks to the value proposition and the allure of the company to the consumer. And they've, by the way, gained share and really started to put some of their competitors out of business as well. Not that we thought there was much threat, but it's further validation of the thesis. The cash flow margin is simply EBITDA plus stock-based compensation added back in. So it's just the operating ability to generate cash, fund themselves, demonstrate a value proposition. And then finally, the margin change is how much that cash flow margin changed point to point from those 2 periods. So at the very bottom in orange there, you'll see across those top 15 positions, they grew 26% on the top line. They had nearly a 30% cash flow margin, which is, I mean, for perspective here, the S&P, you're probably talking, off the top of my head, op margins between 18 and 20%, which is historically really impressive. If you go back in time, it wasn't that good, so we're even above that. And then we had a margin change of 2.9 points. So in the face of COVID, you had way above average revenue growth, and you had profitability improvement on an already strong set of companies. And so this is not necessarily the weighting we went into COVID with. This is the one we have right now. But as we can talk about, we did a lot of work based on the fundamentals, based on the valuation of the companies throughout this period.
And this is what, 75% of the portfolio?
It's probably not quite that much, but approaching.
45.
Yeah.
Well, I bet it's about 50. I would
Maybe
guess.
it's about 50,
Yeah.
15.
So these, what you're calling the minor players, make up more than I thought.
Well, no, there's the minor and there's the mid-tier as well. So we have usually between 40 and 50. We've tended towards 50 positions in the portfolio. So Fred was talking that farm team. That's still going to be a fairly, if you flip to page,
I'm
I'll
sorry.
just show you. Yeah.
Okay, no,
Page 31. That'll show you the actual holdings and weightings within your portfolio. So if you look down at that bottom end of the list, you've probably got a little better than 10 names, 10 to 15 names that are below 1 percentage point.
Got it.
we would call that the farm team,
And
up
then,
or out.
then up at the top end, you'll kind of see the weightings attached to it. So Akamai right there. So these have changed since this chart was generated here. So Akamai is going to be 4.5%, and then it works down from there.
Got it. Okay, thank you.
Yep, of course. We've already, like I said, I didn't realize Ukraine was going to be invaded. Otherwise, I would have put that on slide 15. But we have the vague point, so kind of got there with geopolitical tensions. I guess there are more tensions at this point. There's a bunch of other things. The point I really want to draw out is in contrast to the last slide that whatever happens with these, there's a lot of uncertainty around all of them. Our portfolio is built such that the companies will navigate that uncertainty on a fundamental basis. So we're not dependent on the macro for our returns either. We're looking at companies that 7 years from now, people are still going to have crooked teeth. The line will be there. Akamai supplies infrastructure into the internet. It basically helps deliver content efficiently and cheaply to where it's going and securely. They continue to do that. They're basically the biggest player doing a lot of these things on an independent basis, though that will still be a need 5 to 10 years from now, and a growing need. And so in these cases, the companies can fund themselves, they have competitive differentiation, they have wide and broad customer base, they're very moody with the technology and the innovation they're bringing to market. We like their cultures, we like their management, and I don't think any of those things are going to be dislodged by, you know, a small war in Europe or anything else. I mean, we will have issues. There will be supply chain stuff with China. There will be all these other things you see on the list, but we're not investing in companies based on what we think will happen here, because frankly, we don't know, but we love to talk about it. So let's save that for Q&A. With the projections on a forward basis, we put 12% plus. That's even a little bit higher now. I guess we're 15 or 16% probably as of this morning.
We have, it's been startlingly accurate. Just to give you a data point, in October of '08, we wrote a piece. We were printing up a 25+% expected return. And in March of '09, we actually wrote to the city and said, give us money, we'll run it. Whatever you put in, we'll do it without fees until we're up 35%, because we saw this was about as good as it's ever going to get. It's not as good today, but we're printing up now about a 16% expected return. Well, I'll tell you what, we'll take a lot of risk to get that 16. And it's just amazing what's happened underneath it. And we've made a lot of changes. This, the other thing that we have, if you just think about, we've really researched our companies really carefully. And so last year, entering 2021, we had some of the studs were expensive. And we had some other companies that had high expected returns, but there was some hair on those things, right? So it's a barbell. So we worked all year at it, and we got in December, it's like, whoa, we're looking at it. We have another technology. We can, on a real-time basis, we can actually show the expected return weighted in the portfolio through FactSet. So we're showing 14. Whoa. Well, now we have a broad-based group of stocks that have high expected returns. They're really exciting companies. So that really steps your betting odds. It's not like you're betting on 3 horses that are going to drive the returns. Now we've got probably 20 or 25 that have an expected return of 15% or higher. There's been a real correction here underneath it. It's pick on Garmin, which is a fantastic company, one of the best companies we've ever owned. Stock, went to 180. It's now 114. I mean, it's a fantastic company, and so we got a broader base. It's a very interesting time right now.
But it's way more reassured on the portfolio front. I mean, now it's, with the period that we're looking at, I think people will get squidgy, so it becomes almost a more client-focused effort. But early on, as you watch that 12% plus that we target, that's put together through the whole portfolio. So you'll have names that are above that, names that are below that. They vacillate a lot in price, but it assembles to 12%. We had that. But you had a lot of names that were sitting below 12%, and it starts to make you a little nervous when you see that narrowing of the returns in the portfolio. And it was frustrating too, because we'd trim out of these names at the lower expected returns, you reinvest in the higher expected returns in the stocks that keep going the way they were going. So you'd watch a stock that you just trimmed outperform, and that's like foregone performance at that point. And you're doing it slowly over time, so you're working really hard to broaden the expected return in the portfolio. And in the meantime, the reward for your efforts is watching the stocks you trim run away, and the ones you buy go down a little bit more. And it's a very frustrating time, but the rewards of it are now. I mean, we do see really broad-based returns in the portfolio, and it's way more reassuring. I feel way better about the portfolio at this point just because of that and because of all the work we've done. It's been a long 2 years. On the S&P 500, like I mentioned, based on a few different crosscuts, we do not do individual research in every company in the S&P 500, so this is a top-down look at the earnings power and the historical performance of the index. We see 3 to 5%. That's going to be a lightly held opinion, but we don't think we're going to be too far up based on that. And that's over the same time frame you see at the top there, 5 to 7 years. Bonds, basically getting the yield, and then cash, you don't get much of anything. We've got the unlocking 12%. These are kind of the most important keys to that. We can talk about them more in depth, but because they're a little bit more on the kind of conceptual, philosophical side, in the interest of time, I'll just hand it back to Fred on slide 18 then.
Yeah,
and go to Q&A.
Just one thing we've seen so far this year, the speculative fever is clearly breaking, and not so much do you see in the big caps, but you see it in a company like Shopify, which is a terrific company. you know, it was 40 times revenues. I think, is that, no, it's more than that.
Oh, at points, yeah, I think.
And so I've been through this. The pathology of overvaluation when it's really extreme is it goes down 50% on no news. So that just, you know, and we actually went back and looked, if you had gutsed it out and bought this package of the Hot Ones, Zoom and others, right at the low end, or in March 31st of 2020, right, almost at the low of COVID, you're hardly up at all. You had a meteoric rise and you gave it all back. So what happens is the pathology is, like Shopify went to 1690 or something, and it's now 600 something. If people anchor up this 1790, they say it's cheap now at 600. We're looking at it going, these things bottom when the investment buyer comes in. That's what happens. And we're figuring 300s, maybe 400s, the number on Shopify. So you start the long, slow, break your spirit decline. You get a rally up, and then they just, and that happened in 99. Once you break the fever, it's really hard. And it hasn't broken fully. Tesla's still way overpriced. Now, we also don't think that the S&P, it's funny, we came up with a single point estimate of 3.7%, which is kind of interesting. We didn't fiddle around with it. We don't see a disaster there, because these, like Apple and others, these are great companies, but they're expensive, and, you know, and so our guess is it's a sort of a slow death, you know. So we're sitting here printing up a big number for us. S&P is we don't see as much competition, just because it's just really expensive. It's going to take time to digest it. It's just the order of things. It is what it is. I think in my career, I think this is the best investment team I've been part of. Our decision making is getting better. We're really working at it. Our portfolio looks really good today. You know, we're one of the, because we know our companies, and we have very different conversations. You know, like we went to see Garmin not too long ago, and we're in our second CEO there. We're getting pretty good at CEO transitions, because we've owned the stock for like 12 years, and Cliff Pemble replaced Min Kao, who was the CEO and the founder, right? So that's always tricky. He's been there, I think, 7 years. So we interview him, watch him develop, and so one thing that I would say to you is that, you know, this has to do with inflation and how we feel. What Nick talked about was innovation. You know, our companies they're really running their businesses well. We can see it. And it argues why inflation may not be, we were very concerned in the fall, we're still concerned, but it may not be as big a threat. Because I lived through the stagflation of the 70s, but there we didn't have any innovation. It was before the chip came out. Now we have massive innovation. And we see productivity gains. That tends to dampen the effects of inflation, but also means that our companies are doing a great job of running their businesses. We can see it on a real-time basis. And when you interview CEOs and you see how they handle things in the middle of COVID, and you see what they're doing now, and you see all these things happening, you begin to get a real idea of how they're operating. And our companies are doing a great job. We have a stellar set of companies in there, and a real clear focus. So we're feeling, we didn't feel good watching the news this morning. It makes you want to kind of almost...
We've got one of our young analysts, Alex, he's got parents in Moldova right now, and there were Twitter reports out this morning that there were strikes in Moldova. It sounds like it's probably not the case, but he's been in touch with his parents, so there's a close to home element.
Yeah, there is. So it's
You, one of your young analysts is Ukrainian, right?
Moldovan, yeah.
Moldovan.
So it's right on the border
Okay,
there,
yeah.
in kind of the
Right.
southwest
quick
part
story,
of the country.
Johnny's immensely talented. With the last two kids we hired, they're amazing people. One kid, we have a kind of an underdog kind of focus. So one of the kids grew up in a trailer park just east of Fargo and put himself through college. You know, and the other kid was an immigrant from Moldova, came over and went to University of Minnesota Duluth, sold his home to go to University of Chicago, got his MBA.
On the weekends while still working.
Yeah, well, still working. This kid is a killer, and it took us 7 months to get him on, because we had to get him through immigration. And even he fell in love and married a girl from South Dakota. She's too good for him, which I tell him all the time. But you know, even getting married, we we spent a lot of money and it took 6 or 7 months to get him on, but he's just a very talented kid. So we have a unusual team, different perspective, different life experiences. That's what you need if you're going to be really good. So.
And one question, obviously, we've known you for a long time. You're 75, and you look fantastic. But how long? You know, the question, and you got to be getting that. So tell us, you know, what your energy level, what you when you know the last 2 years have been grinding. Last year was brutal, personally and professionally. But what is your energy level and interest long run and being active?
You know, you make choices about your life as you go along, okay? So I chose, my franchise was never about national acclaim or anything. I care less about that. It's always about clients and employees. And I still get intense satisfaction out of investing and intense satisfaction out of solving client problems. Because we have a great culture, our CEO is world class. He was head of the personal wealth division at U.S. Bank, $60 billion. He was on his way to being president of U.S. Bank, and he didn't like the culture and joined us in August of 2008. Took a 50% salary cut to come over, and he's a better leader than, it just irritates me. I had to work my tail off to be average. The guy's just gifted. He's like a star athlete. So the business side he runs. This is so satisfying. You know, when you're 75, and I've been really lucky health-wise. I'm one of the biggest customers of DGI. I'm intensely interested in how we're doing. You know, share-wise, you know, I'm not the majority owner, but that was a big deal. We've been working at this for 15 years. I wasn't old 15 years ago. I just got written up in a book. It's a really good book, by the way, on investment. I forget what big time investors. I'm in the chapter with Charlie Munger, Buffett's. They gave me 6 pages. Great. I have a nice relationship with the author. That's after 40 some years. So I'm not going anywhere, John. You know, as long as you know, I get a lot of sort of semi-terroristic threats. I have a age discriminating lawsuit in my back pocket, you know.
The poison's been remarkably slow to work. You know, it's just
so here's what age does and wisdom. You know, they keep trying to change the lock, but I got the master key. You know, so you know, so we've done all the steps, John. So and I think there'll be a time when I either can't keep up or, you know, we'll disclose that. But, you know, my dad worked till he was 90. He got fired at 90. He was a stockbroker. He threatened an age discrimination. He was hired at 89, fired at 90. I hope I don't do that, but.
Yeah, me too.
So, yeah. But you know, honestly, I'm in a sort of discretionary phase now, you know. I love coming down here and seeing all of you. You know, this is really energizing for me. It was a horrific loss last year on multiple counts, but hey, you soldier on. So, I mean, I'm living the dream as far as I'm 75 and I get to go to work. I get to work with fabulous people, and we have a world-class firm and taking care of our customers. And I don't know. And I gave up a lot to get that.
Right.
You know, when I sold the firm to the people that build it, you don't top ticket. This was not a deal. We could have sold it for a lot more money and signed a 5-year contract, but I wanted it to stay on. And we're doing that. And our shareholder agreement is not to get rich on. It's not an appreciation. It's a cash distribution model. So, you know, we had stress tested a large shareholder left and a large shareholder died. And we sailed through that. That was 30% of the stock. So that was a big deal. So, yeah, I'm struggling to give you an answer.
No, you're being authentic. I appreciate it.
Yeah, I mean, it's just, you know, I just love doing this. And who else? You know, my friends are retired, and God bless them. That's not me.
Okay.
Your wife would probably kill you if you retired.
Well, we had a thing a few years ago, and it was we have an annual dinner, and somebody asked, you know, what are your plans, Fred? And my wonderful wife, and she said, "Can I say something?" And she said, "He's not coming home." Sorry. So,
For better or for worse, but not for one.
so, you guys have been very good. So, I still, you know, I'm flying us home.
Sure.
The pilot and I have worked together for 25 years. That's an interesting process. And so, I'm just lucky right now, and I see no reason not to keep going, you know. So I'm living, this is really fun. I'm just, sorry, I mean, it's just fun, and I get to do this, and, you know, and I don't have to do all the business stuff anymore, you know,
Right.
somebody else does that. Should go and invest, take care of customers. Woo. So, I wish I could.
Yeah, I didn't
It's a
expect, I was just curious,
situation.
it sounds like you're enjoying yourself, and you have no immediate plans to go fishing for, 7 days a week, which is, I'm pleased to hear.
Well, I can't tell you how satisfying it is to watch Nick develop. Nick's been there 15 years, and Jason is lit off like a candle. And Rob is a world-class thinker. He's been there, probably been 20 years now, you know, and, you know, and we have to feel kind of ourselves, you know, indexing has put so much pressure on everybody. So we have to kind of feel ourselves, you know, and so we're just doing price discovery and doing work on companies and, you know, and we're grateful. We have a great set of customers. And so I wish, you know. So,
Thank you very much for, the long time, and again, as always, you guys bring a lot of insights, I appreciate that. But we have some other agendas, I've got to get some people home for lunch, so anyway, but thank you,
Thank you, John.
you guys both
Thank you
very
all
much for
again.
everything.
So
And
we appreciate it.
all right,
very much.
are there any additional questions from anyone, staff, members? I don't want to, anything, Brooklyn? No? Okay. Great, thank you very much.
Thank you, guys.
Safe travels. All right, thank you very much.
Thank you, guys.
All right, so it's.
Good to see you again.
Thank you very much. All right, man. I'll
Good
be
to see you.
Take care. Thanks. Appreciate
Of
it.
course.
Just gonna take a quick break myself. I'll be right back here. Anyone else need a break?
You saw it. Good to see you. Yeah, follow up if you
Thanks
need
for
anything.
having us down back to back.
Oh, yeah, of course.
We all second chair.
Oh, yeah. Dude, seriously, I'm the only one in back, and I'm always checking up there. Oh, I think his brain's already in the plane though, like he gets really tuned up right before a flight. Yep.
Is that the first time you heard from DGI?
Yeah,
You were on the committee last time when it was remote last time.
yeah. Interesting. Oh, went down 700.
An hour the NASDAQ makes a difference. It wouldn't surprise me as well as the market opens down big and then kind of trades up the rest of the day. 196.
You know that they've gone in, we know.
Right.
You know, all of the fear and everything was priced in before.
The uncertainty is gone, eh?
Right.
Well, now the only question is they just keep rolling west till they get to Portugal. That's,
right.
Which I'm sure somebody's worried about.
They hit Poland.
What is that?
Right.
I haven't launched an armored assault in 75 years, so we'll see how they handle supply chains and mechanical, all the logistics to keep a sustained offensive. I mean, who knows? But it's
I mean,
we'll see.
other than Nord Stream, none of the sanctions are about energy.
Right.
None of the sanctions are about materials.
Yeah, they're all.
Yeah, all banking.
We'll see.
Germany has a thirst for that lovely gas.
Deal with the devil.
50% of their energy comes from Russia or something like that?
40 or 50%.
Tough to take a hard line when that's your.
Well, but they've been so stupid about it. I mean, so many of they were even closing nuclear. I mean, this is.
While France is ramping up, right? They declared nuclear now green energy, France.
Which did it?
Well, that's ironic.
Until
My wife
you
was
get
talking about
rid
it the
of
other day, it's like all of a sudden, this bad nuclear stuff is going to be the power of the future.
Yeah, and it should be.
The problem is you have a Fukushima every so often, and then that's what scares everybody.
Sure.
It'd be nice if they could get fusion going instead of fission.
All right, I'm going to go ahead and call the meeting back to order. I know we're back out, but we want to keep moving along. So again, Brendan, do you have the floor, sir? Wonderful. We have a lot of reports you sent, some of them a bit dated, so given what's going on.
I'm going to start on the big one because I
As
want
of
to.
today, they're dated.
Yeah,
right.
They're very dated, but I do need to. I want to touch on a couple of things. But I'm going to start in the big quarterly report.
Okay.
At the beginning of each year, we include a letter from our CEO, Mike Welker. I'm not going to read you the letter, but it is important to touch on a few items that are contained in there.
Sure.
First and foremost is a thank you. If it weren't for clients like you, we wouldn't have a firm in the first place. I just want to make sure you understand how much we appreciate the opportunity to serve. Kind of an update, obviously 2021 wound up being a very good year in the markets. We finished the year with about $123 billion in assets under advisement in terms of client assets, with 87 employees. We're committed to reinvest 100% of the net profits back into the business. Last couple of years, that's been focused on IT and personnel, and quite frankly, we don't see that changing anytime soon. That's the primary focus of all that reinvestment, certainly for this year and likely into next year. And then the last item, we are a 100% employee-owned partnership. So we're in a program where that ownership is being distributed among a greater number of employees. So we're essentially highlighting that two folks were added to the partnership, Brian Green and Carrie Richardville. That constitutes a change in ownership. It's consistent with the program, but we want to just make sure we're highlighting that for you. Then the last thing, on the next page, the org chart. Now you've had an opportunity to meet a number of different folks, whether it's John Tennis, Dan Johnson, a few other folks, but there's a lot of folks at the firm. We just make sure to kind of remind you of the depth of the team, all of the different pieces of the organization. Again, I don't mean to go in, but I just want to remind you that there are a lot of folks in the background working on your behalf.
Where are you on this?
I'm going to be in the upper middle part of the page, under consulting, left-hand column.
All right.
Then, just to kind of preface some of the discussion, if you go to page number 9, upper right-hand corner, really want to focus on those green versus blue bars. You'll notice the top two sections, the 3,000 and the 1,000, there's a lot of similarity there, but you'll notice 11 to 11.6% out of growth in the two different benchmarks versus 7.5 and 7.8 in value. Now look at mid-cap and small-cap, which complete reversal. Fred kind of talked about this, or Nick talked about those top 8 stocks. This quarter it was actually just 5. There's a dramatic difference. And again, that's somewhat important, because when we look at your total fund, you compare against the Russell 3000.
Right.
It had an outsized influence to really just a handful of stocks. I think you guys already knew this, but I just sort of wanted to point you to a few of those numbers that kind of go into that. The other item that didn't get discussed already is on page number 15, the Treasury yield curve. So all of 2021, we've seen nothing but increases in inflation, but rates didn't really move until the fourth quarter. The yellow line represents where we finished the year, and obviously since then, rates have continued to move even higher. But as the market has realized, they've kind of gone from the Fed going to finish tapering in the first half, maybe raise in July or August, and probably 2 increases by the end of the year. Well, that got accelerated to tapering ending this month, raising next month, and now I think we're pricing in somewhere between 6 and 7 increases by the end of the year. So a huge acceleration and expansion of that expectation. And that's a big part, prior to today.
Is that a classic too little, too late?
But it's interesting, if you look back historically, it is quite normal for the market to take a pullback when they start to realize that a Fed interest rate increase cycle is imminent.
Okay.
Then, 12 months after the rates actually start going up, on average, the S&P's up somewhere between 10 and 15%. So if you just sort of think back, again, Ukraine notwithstanding, China, Taiwan, all of those things, we've just gone through 3 years where our equities have annualized at about 25%. Probably due for a pullback if for no other reason for that. Then you combine that with the fact that the expectation for interest rate increases has not only been accelerated, but increased in terms of scope. And then again, you throw in the geopolitical concerns. It all makes sense that we're having some of this challenge. So again, just kind of wanted to provide a little bit of that context.
Brendan, in your firm's opinion, obviously inflation is high. From your evaluation, how much is that supply chain related that we would hope would ease as supply chains get knit back together, and how much is kind of fundamental monetary inflation because M2 and everything else is so high? I'm just kind of curious what you see.
From a firm perspective, we haven't tried to answer that question to say, we think half of it is due to supply chain. Certainly it is an impact. Aside from all the COVID impact and the stimulus that went along with it. So COVID by itself forced a lot of people to stay home. Less so here in Florida than a New York or California, but you just naturally have pent-up demand. Then, of course, you have the actual supply chain and manufacturing issues that kind of hit at the same time. All the while, you had trillions of dollars being thrown into the system. And you bring all that together, there's inflation. Now, is a third of it due to supply or half? Don't really know, but it's certainly a piece. But I just think generally when you have that much money in the system, and if you saw in DGI's book, they actually had a chart in there about kind of the money supply growth. And it was ticking along at the bottom until 2 years ago, and then it just, and that's what we're going to have to deal with. That's what the Fed is going to have to deal with. The real question and hope or concern is, can they pull a lot of that liquidity back without overshooting? And that's typically the concern. The Fed goes too far too fast and derails the economy, and that's where that concern is. Just want to touch on a couple of quick things. First off, obviously, up for the quarter, 375 versus 5, but we were behind the benchmark. A lot of relative underperformance. A lot of that, again, is focused on sort of those broad indices, select group of stocks doing particularly well. Because if you look kind of manager level against their index, you wouldn't think you would underperform that much. It's in the total fund level we're comparing to the Russell 3000, which was dominated by those names that quite frankly, your managers have very little to no exposure to. But if you look at the last 12 months, 15%, 15.4 versus 15.04. So quite excellent. And then the last thing, I'm going to skip over a lot of the managers. We're going to touch on that in the update. But the real estate portfolio on 22, for the quarter, 10%. For the year, 23.74. Obviously, there's sort of a delay due to how they value their real estate. And in part due to COVID, we had some negative impacts in the later part of 20 and early part of 21. So you're seeing kind of the COVID recovery along with the impact of inflation and higher rates, or at least those expectations. You're owning real assets there, benefit from inflation.
She tried to tell us this is going to happen. Remember when she was talking to us on this, and I just didn't believe it?
I didn't remember 23, but
you're
absolutely right.
But I kept saying, you're wrong. I mean, in my head.
Right. Well, and
She was right.
they have a little bit more visibility, certainly than the stock market. You never know what the market is going to do tomorrow in terms of trading. Real estate, they know what their rents are. They've got their agreements in place, their leases. They know what that cash flow is going to be. And they're already seeing changes in cap
I
rates.
just thought other factors would kill them.
Well, the big one is, office. That's the one that's been getting a ton of discussion. But what's interesting, the more and more I hear about it as we go, this is going to play out over 5 years. Because most of these businesses or these offices are leased somewhere between 5 and 7 years. So you're an IBM, you've got this huge center. You can't just decide, even though you've got people working from home, you can't just rip out the lease. Now the question is, as we move through this process, some companies are saying working from home is great, we can stay remote, or we're going to get to some hybrid environment, where you don't need as much square footage. Other companies who are deciding they need to be in person, they're increasing their square footage. Because, we used to have 50.
Those are offsets?
To some degree, but again, we're still in the early innings of that kind of 7-year lease roll, but that's what they're going to be watching. All the while, these managers, almost all of them, are reducing office exposure. They're expanding to industrial, expanding to residential, because of the question marks to office. They're not running for the hills.
I read some articles recently, residential, if somebody's just trying to rent a space, I guess a place to live is getting terribly expensive. I don't know anything about that
That's
market.
about 23%.
Some huge number.
Well, Brandon, on the office spaces, a lot of, during the pandemic, a lot of these guys said, you got 2 years left, you'll extend it out to 5 years. We'll cut you this deal.
Right.
How is that going to factor in? I mean, it's going to give time to decide whether they want the space or not. But could there be another shoe to drop, say?
It extends the
3 to 5
income.
years?
I can't tell you across all of the managers, but the ones that I look at or cover that have client exposure, there is not this huge balloon of lease expirations, like say 2 or 3 years from now. So they're managing all of that. So if they were extending, if they were doing anything like that, they didn't create this balloon that was going to come up in 26 or 27.
Still be static.
So it's, when you look at their lease expirations, most of them are somewhere between 10 and 15% of the portfolio each year. So yes, now, there could obviously be some impact, but it's not this huge, wave that you've set into one calendar year. But that is definitely something they're managing. And again, this is going to continue to evolve. We don't know yet. A lot of these companies that are 3-4 years away, they don't know what they're going to do. And so it's tough to kind of guess, but the folks that are making decisions already, you're seeing some cut and you're seeing some add space.
It just had,
It'll just be interesting.
our real estate, it's 4.3% of the portfolio, targetly 5, so a little bit. But, and we went into the real estate years ago as a bond proxy. So if we're comparing that piece of the portfolio to bonds, I'd rather have some lease risk in managers that are underweighting office and going elsewhere. I think our return versus bonds in an inflationary environment, I think it's an attractive trade-off. And we've been anything but traditional in our allocations here for a very long time. But to your point, who knows? But in some ways, at 4.3%, I'd say, well, who really cares right now? And I don't want to be dismissive, but it's if it's our bond proxy, I think we're probably well positioned. But you're right, all the companies. The big question, I think, with the office spaces, if you have a business model where you don't have to inculcate culture and principles with your employees, then you can probably be remote, typical call center or something maybe. But I don't see how you build leadership and you communicate culture remotely. I think you're going to have people or social creatures in buildings to be mentored, either formally or informally. And so I've just seen it already where some of the younger people, kids of clients of mine, they're lonely. They kind of like the autonomy of sitting in the bedroom and doing their work, but that's not healthy for long-term development.
From a business standpoint, it's very difficult to keep employees if there is no culture.
Yeah.
Because if you can be home and earn $60,000, then you'll just take another job earning $60,500 from somebody else that'll just keep you at home. And you will constantly have this turnover, just move to something else because your situation isn't changing. There is no culture, there's no relationship tying you to that business.
So we'll see whether we go. Maybe virtual reality will solve that. Maybe we're going to have our own avatar. That'll be fine. I think we're a ways from that.
Transition out of the book, I'm happy to go over more if you'd
Yeah.
like. But obviously, January, the market's kind of rolled over. I was sort of starting the conversation talking about the expectation Fed increases. We're really starting to see that. Interest rates continue to rise, so you're seeing more pressure in particular on growth. So I'm in the 131 or January 31 skinny book.
Oh, this is December, gotcha, okay, I'm with you.
The big one was December, correct, the official quarter end. So the portfolio is down about 4.5%. So on a fiscal year-to-date basis, the 4-month number, we're down about 1%. So certainly not a great start. You know, last year was phenomenal. So if you put it over that context, it's still not a big, huge issue. You know, still double-digit returns for the trailing 3 years, slightly under on the 5 and 7, but still 9 and change, 10.5 over 10 years. So certainly very, very good in that respect. And then if you flip over, you can actually start to see a bit more of manager level outperformance, at least for the month and the quarter date, which are the same. Twin has actually, if you haven't been noticing, they've been fairly consistent the last 4, 5, 6 months, outperforming.
Getting better.
Correct,
Yeah.
it's getting better. So I mean, just this month alone, ahead by 37 basis points. Now, they're never going to be 4 or 5% ahead. Like a DGI or Bailey Gifford, that's a possibility. They'll never do that. Bear Hanley value was down 1.4, but the benchmark was down about 2.3, so that's very nice. And of course, that was offset by Brown, down 12 versus 8.5. So that's where you can really see the growth market being impacted more so than anything else. And then obviously with that concentration certainly not being in the names. Now, a lot of negative numbers going out. Continued conversation. We've got another book to again, sort of update you on that sort of review, and we can talk about that more. Pzena, DGI, again, negative numbers, but relatively very good. The biggest kind of sore spot, if you will, in the month, Silchester and Bailey Gifford were down, and then certainly Bailey Gifford was down almost 11% in the month. Not too far from the benchmark, but a big negative impact. Interestingly, look at the last 12 months. So they're almost 23% behind the index for the last 12 months.
Yeah.
Yet over the last 3 years, they're still annualizing over 5% ahead of the benchmark. So it really tells you how far ahead they were 2 years ago to be that far behind in a year and still be annualizing over 3 well ahead. Certainly a bit of a relative roller coaster, but certainly impacted by China and a lot of the other things that have been happening.
And who knows?
And then Loomis, your fixed income, outperforming, but in a negative environment. We've minimized that exposure, so it's got relatively little impact, but you're likely to continue to see challenges there, just due to the rising interest rates. Try to go through quick questions, comments.
On Loomis sales, I mean, they're benchmark the aggregate. My recollection, they're a little bit shorter on average duration. I mean, how much latitude do they have in shortening up their maturity?
I'd have to look back. Most managers will set, maybe a plus or minus 20% bandwidth on the duration.
Okay.
So in this environment, as most managers have been, most managers are expecting rates to go higher, so they're going shorter duration, but they can only go so far.
Right. Okay.
If they were going to want to do that much, they'd really come back and have a conversation about switching to a different benchmark and a shorter duration portfolio.
Okay. Any questions? Pat, any questions from you?
I think we lost Pat.
Yeah, that's not there.
Okay.
The last book, again, is, you've seen this multiple times over the past few months. It's that growth kind of comparison of Brown against some of the peers. And we've sort of talked at length about the concentration of the benchmark. This is a concentrated manager that tends to be low beta, doesn't own those big names. So from a risk control standpoint, very comfortable with the strategy. But just, again, because I had already created the book, wanted to show it to you. And I think one of the things that might be most helpful is if you look, I'm sorry, I didn't put page numbers on it, but it's the one with all the first page, with the annualized performance. We have a subset here of a bunch of different managers with kind of some different styles. All growth managers, all large cap, but some have a little higher beta, some are neutral to the benchmark, 1 or 2 are lower beta like Brown. Look at the last 1 year in particular, every single one of them underperformed. Look on the 3-year basis. Every single one of them has underperformed annualized over the last 3 years. Although interestingly, all of them with the exception of Allspring, which is formerly Wells Fargo, ranks in the upper half of the universe. The benchmark is in the 14th percentile. And I think that ultimately is the biggest issue. You've had this run in a select group of stocks. The top 10 now represents 40% of the index, incredible amount of risk. And, again, not to say you're happy with underperformance, but from a risk control standpoint, when you look at the plan in total with our equity exposure, we try to have the equity exposure but take less risk to do it, relative to those pools of money. I think that the strategy is still consistent. Yes, you can make a change, but I don't think there's anything broken. They haven't changed what they've done. It's just that the market has been narrow and.
I'm curious, I'd be curious, so I know the NASDAQ index, which actually the full NASDAQ index has about 3,700 stocks in it. The NASDAQ 100 is the top 100, and that's the one that's frequently quoted. I've not been able to find easily, I'm just curious, if you looked at the true NASDAQ, the 3,700, how much that had changed the actual total performance. I realize the concentration is still enormous because of those, it's the NASDAQ 8 index, frankly, if you want to look at that. But I'm curious, if you look at the whole NASDAQ index, what would be the differential performance versus the NASDAQ 100? I suspect some of those smaller companies, many of them mature, I think there's probably a bloodbath in the bottom 500 or 600. I'm just kind of curious.
Sure. Yeah, I don't have to try to take a look at it, but
yeah.
And then in your packet, I didn't print any other copies, but we included the most recent drawdown chart month end, obviously with the correction. So that's in your packet. You can see, again, over the scope of what has been the last 12 or 13 years, what we've just experienced is just a speed bump. But
the second slide, the second chart on that, if you can have that.
Second page.
Yeah, that is, I've used that many times with people saying, well, can't we just step away or double up? I said, look at the number of days where basically the moves in the market are very violent up and very violent down. And unless you're in the game, or your advisor's clairvoyant, which if he is, he deserves a great deal of high management fees. If you just look at the stats in terms of you miss, you're trying to be cute, and you just, the benefit of owning stocks dissipates if you're not willing to suffer through what we're going through right now. And so that is just statistically, it's almost irrefutable to me.
I haven't seen the numbers recently, but it has been discussed in the past. The average, if you go back 100 years, the average stock mutual fund is earning, call it 10% annually. But the average investor in that fund nets 2. And that's why.
And hence our discipline, and we, as a firm, or as an organization, we've chosen to be highly exposed to equities. We've been paid really, really well over time, but there's times like this where it stinks. But you can't get the long-term returns without suffering the short one.
And to kind of to Fred and Nick's point, it creates opportunity. Every time you go through one of these cycles, they get to, if your managers have discretion to sort through and find what you want versus, I know index is very popular. Anyways, but thank you. Happy to answer any other questions if you have any.
I don't have. So it sounds like, if I hear you saying, is that Brown is doing their job. They're probably less
that's what
risky.
he's saying. Hang with him is what you're saying.
Again, nothing has changed. They're not drifting style. Again, they're a concentrated low beta manager. And when you're concentrated outside of the biggest weights in the index, and those are the ones driving it, it's an understandable miss. We saw this in the late 90s into the early 2000s, where in growth, the top 10, which normally is 20 to 25% of the index, got into the 30s in terms of percentage. Then it spent the next 7 years unwinding itself. And so if you own Cisco, if you own Intel, if you own those big names from 2000, you didn't do well for the next 7 years. Now here we are with the top 10 up near 40%. It's a similar, we passed those levels from early 2000. And again, maybe this continues for another 5 years. Nobody knows. But the last time it looked like this, we had an extended period of that being unwound, and the benchmark was not the place you wanted to be. So,
Thank you.
How different is the business model though?
They are different, but I think it really ties into kind of valuation, as Fred was referring to. Those stocks have gone so far, they're being valued at 30, 40, 50, 60 times earnings. And they're great companies. You know, Cisco was a great business, Intel was a great business in 2000. It's just what you had to pay for. You had already, you know, you were paying for, you know, the next 6-7 years worth of growth.
I think Cisco, it was almost 18 years. You bought Cisco at the peak, it took you 18 years to basically get to break even. You know, great company, they hired a bunch of people, their earnings were growing, but if you, as an investor, if you paid up to, you know, at that wrong time, it was a very, very
Is
painful.
it a safe assumption half of the big eight are kind of shaky right now?
From a valuation standpoint, I think that's probably a fair assessment. Now, the fundamentals generally are quite good. So if the fundamentals stay good, what you'll tend to see is the stocks do relatively little and let the fundamentals, let the earnings catch up over time. So it's not, I mean, obviously there's a couple ways to fix it. One is just the stock goes from here, you know, the fundamentals are here and the stock is here because it's now trading at 30, 40, 50 times earnings. Well, we can close that gap in a day. The stock drops 50%, 60, whatever it is. Or the stock, relatively speaking, does nothing for 5 years and the valuation, the fundamentals catch up. And that's more the hope.
Look at Netflix, and there's so many people going to be competing against that. You know, like, always get away from even save media companies. Everybody streams all their individual, like
Certainly.
they want HDTV or they want Paramount or they want Disney.
If that company doesn't have a moat around it, if everybody can literally just push a button and leave and go somewhere else because the value proposition is better, there's certainly a lot more risk there. You know, let's use Tesla as an example. You know, they're building a product that people want. They're expanding all over. There's a little bit more of a hard good. They're a little bit more of a fundamental, you know, not to say that they're priced where they should be or anything like that, but I think a company like that that's building market share, that's selling more and more every year, there's more of a moat to a business like that than say a Netflix as an example.
We'll watch that. Everybody in the world starting on EVs.
And maybe that was the, you know, but again, whether it's Microsoft or Apple, you know, these are the ones that have been driving, you know, but fundamentally they're incredibly strong. It's just what you're paying for them.
You buy a piece of real estate, you know, beachfront property, you buy it, you pay too much, it's a beautiful house, you live in it, you enjoy it, you try to sell it, you know, 5-10 years later, if you pay too much, it was still a great house, like a great business, it's just a poor investment. And I think, my opinion is, some of those companies are falling into that category. To go on, so we have our calendar meeting that we're giving out. Thank you very much, William. I know you were.
What'd you decide to do about December?
It's really up to the committee. What I would recommend is, you know, that we go ahead and schedule it, and then, you know, you can talk about it in October or November if you think you want to have it. One thing that Pat had pointed out, and I wanted to bring it up, and the reason I included this again, and I'm sorry, I attached the wrong document to the email that I sent out. The reason I included this again was because there was some question about some internal procedures that had sort of been put onto us regarding approval of agenda items through our agenda tracking system, which is called Legistar, but which is complicated. We're moving away from that, I think, in March to a different system. Previously, you know, we would just, the P&I staff would create the agendas and the agenda items and the backup, put them through the system and publish the agenda, because it needs to be published to the city's website,
Right.
Publicly noticed. And so I guess toward the fourth quarter of last calendar year, the finance director, who is no longer the finance director, at least on an interim basis, she may come back as the finance director, but
Is that Cynthia?
Cynthia.
So what happened there?
I'm sorry, I thought I maybe had mentioned this, but I forget who I've spoken to it about. So there were some pretty significant organizational changes over the last quarter here at the city. You know, the city manager left in November of last year, and we have a new interim city manager who is Cynthia Curry.
Right.
And Ms. Curry came in and made a number of organizational changes. She terminated 3 assistant city managers, which I'm not sure why we needed 3 assistant city managers to begin with, but that's me personally. And we also terminated an assistant finance director, Diane Wilson, who had been here for a few years. And then Cynthia Ramos, who had come about a year ago as a finance director, hired by the former city manager. She was moved out of the finance director position and into a sort of a citywide policies and procedures review and updating type of position within the city manager's office, but no longer in charge of the finance department. That may change, she may come back, but right now, I don't know how much you all follow the news, but there were issues with our accounting area.
Yep.
And our ability to internally generate our annual financial reports. For the past 2 or 3 years, we've been having an outside auditing firm actually prepare our financial statements and our annual reports. And so there was a perceived need to bring in some outside help. So right now, you saw Mark Benton was here. Mm-hmm. Mark and Claudia Raznick, who's the CFO at GRU, are temporarily overseeing the finance department here at the city.
Okay.
And they're in the process of trying to hire a new accounting manager, a new controller who would be, sort of an assistant finance director level position, but would focus on accounting. And then there are probably 3 accountant positions that need to be hired as well. So there's just been a lot of turnover and a lot of loss of experience and knowledge in the accounting area, and that's the reason for a lot of the issues we're having. But in any event, Cynthia had implemented some things before while she was still the finance director, including a requirement to have all of the agenda items for these meetings and also our police and fire pension board be approved by a list of like 6 people. And it went from her up through, assistant city managers to the city manager. And, it created a strain on the time frame in which we had to get things done in order to get the meetings publicly noticed, that sort of thing. That may be changing, we're not sure. The reason, we brought this schedule to you in December, but I wasn't sure how the meeting dates might be impacted. I thought we may have to push the meetings back by a couple of weeks or something like that. But it looks like now maybe that's not the case. So if the committee is comfortable with this schedule, then we can go ahead and accept it, and we'll send out all the invites and get them scheduled next week. The only thing I would mention is that November 8th, it was pointed out, is Election Day. That's not an issue for me, but I don't know if it is for anyone else on the committee. All right. Then that.
I would have already voted long before that.
Right. So if the committee accepts this, we'll go ahead and get it entered into the system.
On the legislature, just a quick question, this is off, but is there a mechanism to view or to determine how many people are actually viewing the agendas that we spend all this time and effort producing before the meeting? Is there any, Google Analytics, I'm just kind of curious.
Not that I'm aware of. I can ask the clerk's office about that, if they can see who goes in and downloads the agenda or the minutes or the video.
And I'm all in favor of sunshine, new government, and publishing that and being transparent, but I know the amount of effort it takes to get that.
Well, we didn't used to publish the agendas and minutes.
Okay.
If someone requested them, we would provide them because they are public record. But we didn't put them out on the city website previously because even though the investments aren't confidential, some of the material is proprietary that the managers have.
Sure.
And we just didn't think it made a lot of sense to advertise, that, here's $500 million that's invested by the city. And, I already get dozens of calls and emails from potential managers. And And what we end up getting now are public information requests from these money manager newsletters and these, you know, intermediary marketers that are trying to shop us out to managers.
Right.
And it's time consuming, but.
Okay. One other, just administrative, I noticed my parking pass on everybody else. I think it
Yeah, I
expires the
noticed that
22nd. Is there, as much as I enjoy contributing my talents here, I'd rather not contribute to the parking.
We'll have Becky get new ones for
Okay.
you, and,
Yeah, they run out next month.
Yeah.
I didn't look at mine, I was hanging up.
Yeah, I just happened to look at it this morning, and it's
okay, we'll
March
have
of
them for the
22.
next meeting, unless, you know, I mean, we'll have them before then. if
Didn't
you
do
want.
me any good, there was no place to
I
park
was gonna
out
say,
there
they're
on
getting
a
few
second
far between
anyway.
now.
Yeah.
So I parked over here, whether, I proudly displayed my placard, but it may not do any good, I don't know.
Yeah, well, I'm not sure. I know parking is an issue. You know, the city reserves certain spots for directors and things like that in the lot, and actually pushed, you know, employees out into the on-street parking and that sort of thing. And then, of course, years ago, we gave away all of the parking on the east side of the building to the Commerce Center, so we're not allowed to park there any longer. So it's difficult, but
Well, if you could get us a hunting license, that'd be great.
we'll do that.
All right. Any other items? Greg, anything from you? No? Okay. Well, having seen we've gone through our agenda, I entertain a motion to
So moved.
close. Second, meeting is adjourned.